Good morning, everyone. My name is Bruce Lynn. I'm one of the managing partners of the Financial Executives Consulting Group. We're going to start the main body of our presentation in just a moment. For those of you who have just joined, I've got a little bit of feedback here.
It's me.
Okay, sorry about that. Again, my name is Bruce Lynn. I'm one of the managing partners of the Financial Executives Consulting Group. We're going to start the main body of our presentation in about a minute. I want to leave enough time for everybody to log on so we can all start at the same point in time. For those of you who are on the line, this is recorded. If you do have questions, please write them into the question box on the lower right-hand side of your screen, and we'll get to them after the formal part of the presentation. If we don't get to them online, we'll obviously take them offline, and because you've typed them in, they will not get lost. If you're looking for copies of the presentation, you could expect those in the next 48 hours or so. And that is it for the administrative announcements. So let me go away for a minute, and then we'll start very shortly. Good morning, everyone. My name is Bruce Lynn. I'm one of the managing partners of the Financial Executives Consulting Group. And we're going to start the main body of our presentation, Avoid Earnings Damage, How to Steer Around the Proverbial Foreign Exchange Iceberg. I'm going to introduce you to Jason Roof, who is the Director of Foreign Exchange for GPS Capital Markets, who will carry the main body of our presentation. Again, remember, please type your questions into the question box on the lower right-hand side of your screen, and we'll get to them after the main body of the presentation. We are being recorded, so if you have to leave, you will find out at the end who did it. So with that, let me turn this over to Jason. Go ahead, you have the floor. Jason, are you there? I think you're on mute here. Oh, there you go.
Yeah, a common mistake nowadays, I assume. But thanks, Bruce. Thanks to you and to the audience for joining us today. I'll just provide some framework for this discussion quickly, and then we'll move on into the topic. So what we do, GPS, we are specialists in foreign exchange and financial technology. I like to say that we are consultants and advisors that also implement the strategies and execute the transactions, trades, payments, etc. for clients. In addition, that somewhat differentiates us, we offer proprietary FX management software. We have our own developers on staff, for example, and provide hedge accounting services to certain select clients. For those new to FX, we educate and help them begin with the topic. And for those that are more experienced, probably many of those in the audience today, more experienced with the odd subject matter, we help them optimize and improve their programs. It's also worth noting that while I've spent most of my career on this side, serving the client, I have been the client before. I've worked briefly in treasury at 2 multinationals. So for a short time, I've been in the position of the members of this group here today, experience that I value greatly, gave me great insights into what treasury professionals deal with, financial professionals deal with daily. And you'll hear me say through this presentation that I've seen many of these things personally during that experience. So the benefit that Dave, Rob, and I hope to provide to you in this session is to distill or encapsulate our collective experience working with hundreds, probably more like thousands of companies through many years. We've worked with everything from the simple to the complex to the small to large, and we've seen FX done well and not so well. So we hope to provide insights from that collective experience and boil it down for the audience. with that, we'll go into the heart of the matter, the topic at hand, and we will interject anecdotes and examples throughout this to make it as interesting and relatable as possible. So jumping right in, 5 common icebergs that we see. Probably what you see in other business functions as well: data, systems, and processes. Inaccurate data, incomplete, unclear, disparate systems that are not connected well, no defined process can cause, and I'll say this again, I've seen this personally, can cause losses because in balance sheet measurement, intracompany netting, cash flow hedging, because the data is inaccurate. Mismatched hedges, for example, can create those losses. And then financial leakage, I like to call it, using the nautical theme here. Inefficiencies, unnecessary conversions or hedges, selling pound sterling, buying it back same day or shortly, within the same time period, or not hedging your natural positions against one another. Redundant, excessive payments for fees, fees for payments and systems and so on can create that leakage. And then lack of communication, collaboration between the groups. We'll talk about the groups that we all know deal with that, and then some that we would be surprised that they deal in FX or how contribute to the process. And actually, I'll pause there. And Dave, I think we talked recently about an example of a client that really, I think the situation was, the first 3 applied to that client. Do I remember correctly?
Yeah, and it's one of these things that I was dealing with a client it's been actually in the last week, and they were dealing with data issues, system issues, had all kinds of financial issues going on, lack of communication. And I'll tell you the quick story. We had it's a US company. They've got a subsidiary in Belgium, and they were working on putting in together a program to do netting. And we had set that up last week, and we had started the netting program last week, and we had done some net hedges for them on the dollar against the euro. So there was some exposure on both sides of the market. The very next day after we set that up, I get a call from the controller in Belgium. He's like, "Hey, I'm trying to do some deals over here, and these deals were going to kind of mess up their whole netting situation." And we got the headquarters on the phone, and he's like, "Well, yeah, I didn't tell you about all these deals I needed to do because I just wanted to kind of try it out first." Well, one day after they started their netting program, they found out that if he had have told them his real exposure, not a fake number that he gave them, they would have almost been perfectly netted off as a company, and it would have reduced about 40 million euros in trades. And it was a communication issue back and forth, as well as a cultural issue, because he was holding this back because he just was not really comfortable with the parent and how the parent was doing things, and kind of wanted to go his own way. And a lot of times when you aren't coordinating well as a company and do not have everybody on the same page, it can cause some financial distress because of communication issues.
Yeah, you see the people factor, the human factor come into play there. So it was maybe logical on his part, but illogical for the company as a whole. And so that's why I say the first 3 apply: the lack of communication, collaboration, willingness to collaborate. Financial leakage in another way, like the unnecessary hedges that Dave mentioned, they would have been perfectly offset. I'd say also hidden funds, that could have been liquidity they used, or if they borrowed funds they didn't need to, and it could rear its head in many ways. So that's why I say that it's really the consummate example of the first 3. Moving on to 4, discontinuity. Maybe this doesn't occur as often because change in control events, absence, attrition don't happen as often, but the lack of a defined, formalized, consistent process, and no system of managing the ERP data consistently can create problems if there's a change in control, an acquisition, cross-border acquisition, or even a domestic one, divestiture and so on, or the reality of employee absence and attrition. You know, that person manages that process, but he or she is on vacation. Well, what do? We don't know. So can very much create a problem. And number 5 as well is more of an abstract, but still real at the same time. And I've seen this personally. It can really burden the teammates mentally, and then cause it, you know, dispirit the teammates, lower morale, and so on, and eventually potentially to attrition and disruption to operations. I mean, it does. And Dave, actually, you know, during that same conversation, you brought up we talked about this very topic, and it was a situation in which the CFO considered the process to be very automated, but in fact it was not. Do I recall correctly?
Yeah, I was working with a company that had a lot of foreign subsidiaries, and on the call that we had, the CFO made the comment that, hey, this is no big deal. I get that report every single day, and I know exactly where my exposures are. Well, that automated report that he got every day was taking multiple employees' times, full time, every single day, to compile a bunch of information from disparate ERP systems across the globe. And it was basically 3 or 4 people working full time to create this, quote, automated report the CFO was seeing every day. And, you know, he loved the report. He just thought it was a push of a button. And it was really a lot of full-time people's efforts just to come up with that report. So understanding, you know, where are you getting your data from, and how is it being delivered, and how accurate is that? Because if you've got 3 or 4 people manually keying in data all day long, every single day, you get a little bit blurry in the eyes, and you want to make sure that you've got a system that truly is automated and that really is not going to have, you know, key input errors because of somebody miskeyed something.
Yeah, well said. Yeah, I mean, I've worked during my experience in Treasury, worked with reports, Excel spreadsheet. Oh, you have to copy and paste this, adjust this cell and such every day. That's just not good in many ways. So this is, of course, not the exclusive list. There are others that we could think of, but we want to boil it down to 5 common, and probably the most prominent that we see regularly. What to do about the problem? How to avoid trouble? On the left here, we see, I like to, you know, a graphical representation of exposures and what companies see, both intra and external exposures, and what's the effect of that collision on financial performance. 800,000 positive, million negative, who knows? You know, if hedges are mismatched, if data is unclear, that causes mismatching of hedges. That can very much be the case. Very much uncertainty of the outcome. So how to avoid it? Well, focus on optimizing the program and the approach. Clarity of data, very important. You know, calm, confidence. You know, I mean, calm might be a stretch given that corporate, you know, life is often very challenging anyway. But confidence in data through better predictability, visibility, and so on. So measuring to manage, having a process and a system that can do that for you, that can do things for you, very helpful. And spreadsheets have their place, let's be fair, early on, an investment in software or in the time of doing so. Implementing software is maybe not worth it, but eventually a company would want to graduate from spreadsheets to a software platform that organizes and analyzes ERP data to help prevent, you know, for the aforementioned reasons, prevent the collision with the icebergs. But also, somewhat today's example as well, it does enable more accurate, clearer, and faster reporting. In this case, the CFO, it was fast to him, but just in general, the process is easier for reporting for management. And then the theme again of consistency, organization for both, you know, the method, the policy, and the process. A very good approach. It's wise to focus on that. To prevent the financial leakage that we mentioned before, net what you can, incoming, outgoing payments, also opposing exposures, long one currency, short the same currency, as much as possible, net those exposures, and also use an intra-company netting tool for the greatest efficiency, the greatest financial efficiency with regards to FX. Establish objectives and focus on achieving them, of course, very important. Minimize risk, both cash flows, balance sheet gains and losses from the balance sheet. Focus on budget rates. Don't just hope is not a strategy. Have a reason why you have a budget rate for certain currency pairs or for all currency pairs, and follow that rate and that plan. And also, I'd say customize the approach to FX risk, currency risk. Align it with how you approach risk, other risks, right? It shouldn't be that you're very risk tolerant with FX while you're risk averse in other matters, all of the other business functions. So really align it with how the business conducts itself, the company conducts its business overall, is a wise move. And then assess annually. I would say, what do you do well internally? What could be improved? The providers, do they deliver something of value? How well do they perform? It's a healthy exercise to do that annually and just ask those questions. And if it's going well, that's great, continue. But if it's not, you can always adjust.
And let me, this is Dave, and let me just jump in and throw a couple of comments and thoughts in here too. If we go back up to establish and achieve hedge objectives, I have got clients that have wildly different hedge objectives based off of the structure of the company, how the company's exposures are internationally, what their competitive situation is against their competitors. And that can really make a big difference in what your hedge objectives are. And it just because one strategy works really good for one company doesn't mean it's going to work for yours as well. It really depends on what kind of risk you've got and what type of a threshold we're looking at, a time horizon. So you really need to put a lot more thought into that one. And then the last one that Jason just spoke about was assessing the program. And I will tell you that that's probably where I see most people putting the least amount of time in. Once they've got a program in place, they want to basically just say, all right, well, we thought this out, so it's going to work, and not going back and actually doing back testing on that and seeing how effective that is. And that's something that we can do to help out with. I know that Jason has got a number of clients that have him go and actually do the back testing of their program to help them understand how effective that has been.
Mm-hmm. Exactly. I think, to be fair, David, you chime in. It's often seen as extra work, which it is. And the finance and treasury teams are very, very busy, have many things to work on. So the idea of doing one more thing that's retrospective, as opposed to, it doesn't appear to be proactive or forward-looking, might seem like that's something that can be not a priority. And that's fair. But that's where, as Dave mentions, that someone, an advisor like us or whichever advisor you use, should do the heavy lifting on that. So it should be, less of a burden on the client and more a burden, or, for the FX advisor to handle and generate. Yeah. Moving on. So we talked about processes and such, but what are some best practices? What do we see? It's I think methodical approach is very good. So 4-step process, not rocket science, identify the risks, the exposures. The source and the reason, I think, is good to know as well. It's not just the quantitative, what are the numbers, but what are the qualitative factors here in play? Because, what if it enters into the decision, later into what to do and how to handle the risk. So not just the quantitative, but the qualitative. What is the reason for this exposure, such that you don't change something later on because it looks good on by numbers, but for the business it doesn't make sense. So good to know, again, the numbers and the reason why. Quantify risk and the potential impact of financial performance. Let's go to the left side of the screen here for that, and we'll graduate from a very basic to more complex. Very basic scenario analysis. I've done this many times with clients. Quite simple. Just take, let's say that I have a 10 million euro contract with the German government due at some point in the future. I'll apply some shocks to it. Well, euro goes from 120, about where it is now, to 110, and in increments 119, 118, and so on, down to 110 and up to 130 the same. Really basic math, basic spreadsheets, and just to quantify, okay, how much does that affect my US dollar receipts of that contract? A little more advanced would be a value at risk. Very common. We use this internally. Banks use this. That expresses not the absolute certainty, but with the highest, a certain level of probability of confidence level. What can I expect my maximum expected loss to be? These are, standard deviations. 2 standard is about 95%. 3 standard deviations about 99%. And so that's a very common method and a good one at that. A more complex method is cash flow at risk. It's more of a risk map, and it really goes into greater detail across the entire organization, incorporates many different factors. So again, that's why I say that it goes from the very simple to the more sophisticated here on the left side of the screen.
And let me point out that that we, as a foreign exchange company who help clients all over the world manage risk, our foreign exchange risk is massive because we're putting transactions on for people. We use these exact same tools and processes internally when we're evaluating what our credit risk is and what risk that we have in the marketplace. So it's not something that professional firms don't use. It's something that professional firms use every single day. And if you can use those tools as a corporate, it just makes you better at what you're doing. And most of this is embedded in our tools and our processes. So if you are doing business with us, you've got access to this kind of technology.
Yeah, thanks, Dave. So now that we've quantified the risk with whichever method, now it's time to select a hedge. How do I tackle this risk? How do I mitigate it? And the idea would be to match it, closely as possible to the potential impact and the probability. For example, is an acquisition a project that I've submitted a bid on, and that maybe needs a more flexible strategy because you need to hedge your risk, but you don't want to be locked in to something if the project, their acquisition doesn't go through. And so that's when the option strategy would come into play. But if it's I'm a sub of a German company to which I pay €1 million a month like clockwork, a forward contract, very fixed, inflexible hedge would be the way to go. And also comply with policy that you've set. And a policy doesn't have to be some extensive document. It can be just a very 1 or 2 paragraph policy. We hedge 80 or 90% of forecasted risk and so on and so on. So it doesn't have to be that complex. But again, the selection of the hedges should, of course, somewhat state the obvious, match the actual the risk and the situation. And then today's point as well about assessment, not only ongoing assess your providers, your program member, all, but the hedges individually, and the approach has it achieved its objective. And again, today's point, it's somewhat of more of a burden and not an important after the fact. But this is where your FX advisor should really do the heavy lifting to help you evaluate that, because it is a valuable part of the process. Dave, Rob, anything else before moving on?
No, I'm good.
Good. So let's take a break from some words here. Let's look at some visuals here. And we all know what happened in March of last year. But this is just simply to illustrate using the nautical theme still of icebergs and oceans. From Tranquility to Turbulence, many in the audience have probably seen or noticed that it was pretty tranquil for a while. Some currency pairs volatile, but most of the majors, a 5% decline in the euro over year, not that big of a deal. But boom, March comes along, extreme volatility, and then we see someone a company that has to buy or an entity of a company has to pay euros against dollars. Well, their expenses, their costs have risen, rose 13% within a year's time. And I could even reference others, the more volatile currency pairs like the Brazilian real since the beginning of 2020 has weakened 40% against the US dollar. In this same period of March here, within the month of March of 2020, the Mexican peso weakened 25% against the US dollar. It depends on which side of that equation you're on. So it could be great for you, could be not so good. And so the idea is that simply don't assume that calm seas will continue. Always have a plan, and don't make assumptions based on current conditions. And that plan can change throughout time, and it can be very customized to your situation. And worst case scenario, some disaster insurance, for example, even if it's if you don't think things much will happen, but you need to protect against that black swan event, so to speak. But at least have a plan and implement it. Dave, Rob, any comments you'd like to add?
Yeah, I can. Yeah, I've got a couple things I wanted to talk about, because I had some clients that had been looking at their euro exposure, and really, if we look at the stability in the euro, it was really more than just throughout 2019. It had been 2 or 3 years.
Yeah.
And the person of the company that I've been working with really entered Treasury about that time, and for her entire life cycle in Treasury, she saw the euro as being hardly volatile at all, because the whole time that she'd been in Treasury, there had been very little volatility. When we saw this big change from low to high volatility in the euro, it really kind of rocked their world as a company, because they were not prepared for this. And it's something that we talked about hedging and trying to manage exposure, but they had zero motivation to do it because of the low volatility in the currency. When we saw this big change in volatility, really impacted the company, because they had very low margins, and they worked with really low margins. And when you're working on, let's say, an 8% margin, a 13% movement in your underlying cost, that makes a big impact to the company. And they went into panic mode. And their basic question was, can you go back and get us that rate from a few months ago? And that's not really possible. You have to deal with the market where it currently is today. And you don't want to be in that situation where you are behind the 8 ball and are not able to get your transactions on in a way that's going to make it so you can still be profitable as a company. So forward looking, even if right now times are calm, the water's nice and glassy, doesn't mean that storms aren't coming.
Indeed. And that's where the customized advice, if in that situation, okay, you think everything is going well, put in some a flexible option strategy that's, up in, the 113, 114 area, that, gives you, I like to call it disaster insurance. And so there, again, so many ways to approach this, and that's where a more detailed conversation will help. Moving on. So many in the audience probably you're familiar with FX, but let's just talk about FX in general, both in the marketplace and then also to the, specific to the company. What affects FX rates, interest rates, I think first and foremost, makes it more or less appealing as an investment relative to other currencies, of course. So the US dollar, when they started to raise interest rates, Fed a few years ago, came strengthened against the euro, because the euro's rates were still nailed to zero effectively. So the dollar is more attractive in that scenario. Economic and trade activity, which drive the data, which drive the monetary policy, the central bank, which decides on interest rate policy. So back to interest rates. I think that we've recently seen the most the textbook exogenous shock, external, unexpected, maybe black swan event, you could call it that, perhaps. So we've seen that, specifically how it affects all markets, but FX especially. Political events, we've seen this again in recent history, affects trade policy, fiscal spending, who runs the Fed. That's a long-term appointment, but when it comes to that is very important. And also the Department of Treasury and so on. The head of Treasury, Secretary of Treasury, obviously very important. And stock markets, bond markets, commodity markets, these are all intertwined, I like to say. For example, the commodity markets, Canada's exports, I think, are 50% oil. So not always, but often as oil goes the Canadian dollar, or a correlation is there at least. if not the same percentage moves. So, and same with Mexico and Brazil, for example, countries that export very many commodities. So they're all intertwined, joined at the hip, so to speak, I like to say. And somewhat state the obvious, but sometimes not so obvious. Any company that does international business is exposed to currency risk directly or indirectly. Directly being, of course, if you deal in something other than the dollar or your functional currency, but indirectly, and we'll end on an example of that. If I deal in US dollars, for example, but my dollar prices move around, or I'm less competitive if the dollar strengthens, those are indirect risks that should be acknowledged and addressed also. So on the right side, we see some typical FX exposures, balance sheet items, of course, foreign AP or non-functional AP, AR, cash, intracompany, so on and so on. Forecast exposures, revenues, expenses, translation of earnings, net investment, and have facilities around the world. I have a net investment in those currencies relative to my functional currency. Repatriation of dividends can come into play as well. And contingent, I mentioned before, cross-border acquisitions, for example, or a contract. There is risk in the bid to award cycle or part of the phase, bid to award phase, that can significantly impact the deal, the valuation, and whether it's still attractive or not. And so that's something that should be managed actively, even if it's a more flexible strategy, like with options, for example. And I'll mention briefly on the functional currency, obviously it's somewhat obvious monetary unit of the primary economic environment of the company, but not always. There are some exceptions, but usually it's the case. And it's based on things like cash flows, sales prices, expenses, finance, and so on. And occasionally external factors like hyperinflation. In fact, I recall one entity where I worked, one company at which I worked had to change the functional currency of its Argentinian unit from ARS, from Argentinian pesos, to US dollars because of hyperinflation currency. So it was somewhat dictated to us, so to speak. We didn't really have a choice in that matter. So I'll pause there. Dave and Rob, anything you want to add?
I'd add something just maybe on the functional currency note. In terms of data coming in and data out of people's systems, we do run against quite a few companies that think they know what those functional currencies are, and they'll say, yeah, they're all local currency functional. And so they expect that their expenses are being naturally hedged against that. And yet when they pull data out of their ERP system, you can see when the system was set up and configured that either that they have US dollar, for example, for all those smaller entities, US dollar functional. So what they think those local expenses are netting against local functional currency, that's not the case. And what happens is it's when you remeasure that at the end of the month, they are having impacts that they don't understand. And that's sometimes a good thing to review on a quarterly basis or a couple of times a year. What are our functional currencies? You talked about communication earlier, a conversation between accounting and treasury to just make sure that as acquisitions happen or you change systems, that make sure that functional currency is properly noted. And then, because that's how you're going to need to manage that in the data that comes out. Not only do we see the wrong functional currency, we have cases where a single entity will have 4, 5, 8 different functional currencies, which is a different set of challenges. But that's something that I see it on the slide here. That's something I would note. Ask yourself, what do I know about our functional currencies of the entities we've got around the world?
Yeah, I think thanks, Rob. That would fit under the category of again, a hidden risk. What you don't know can hurt you, right? So it's embedded under systems, under acquisitions, under whatever, but it still can cause problems. Good, thanks, Rob. Continuing with that theme of communication and collaboration. So it seems to be obvious, of course, treasury and finance, even accounting, they're involved in FX. But if we broaden the scope and consider, a broader view, how many departments, how many teams do in fact participate in the management of FX? procurement, negotiates contracts in foreign currencies or with clauses. I can speak specifically to, I recall in my brief work in Treasury at a multinational, we tried to avoid the financial leakage, the conversions, the unnecessary conversions, right? And so we found some quick areas to, arrangements to modify, to improve, to avoid those conversions, unnecessary conversions. And then we presented some others to procurement, and they said, well, that needs to stay as is, even though it's not good for this business entity because it's not their functional currency. As the company as a whole globally benefits better from the fact that this is priced, this contract, this agreement, even though it's been based in the currency other than that functional currency of that entity. So collaboration is, as always, very important. Sales, marketing, very similar as well.
Can I jump in there on that one real quickly, Jason?
Yeah.
Because I've got a client that has been dealing with an issue that was caused by their purchasing department all year long. And it's a company that buys a lot of product from China. And the interesting thing about it is their purchasing department had gone and negotiated contracts with their vendors in China in US dollars. And with the understanding that they were doing a great thing and not putting the company at risk, the headquarters went out and signed some long-term contracts with the vendors that they sell their product to. And this is a product that they have very, very low profit margins on, less than 8%. And after they had signed these with their good clients, we saw a dramatic depreciation in the US dollar against the Chinese renminbi. And their Chinese vendors came back and said, hey, there's been a big move in the currency. We're going to increase our price to you by 12%. And all of a sudden the company freaked out because they only had an 8% margin to begin with. And if all of a sudden your price goes up 12%, that does not correlate. You can't just absorb that. You've got to reprice it to your clients. The problem is they had signed long-term contracts. And they had been under the understanding that they were under long-term contracts in China, but when they started digging into these contracts, they found that there was some repricing agreements in there, that if the market moved more than 5%, then the Chinese could come back and ask for price concessions. And that's exactly what they did. And Treasury didn't know anything about this until after the fact. And it's been a huge struggle for this company all year. They've basically been losing money on every product that they sell because they're locked in with their vendors, and the agreement allowed their Chinese counterparties to change the prices on it. If they had have been priced in Chinese renminbi, they could have gone out and hedged that in the marketplace, locked that in, and known exactly how much they were going to have to pay over the next 2 years, and they could have avoided that problem. And this is we're talking volume wise in the $1 billion plus a year, and if you look at 10% of $1 billion, that starts turning into some real money. That's $100 million a year, and it's made a big financial impact to the bottom line of this company. And that's something that we don't want to have anybody have to deal with. So making sure that purchasing is part of the Treasury is part of that conversation when purchasing is going out and making contracts. It can really be vital to the even survival of the company.
Yeah, well said, David. I've had numerous conversations about this, and this is what we talked about earlier, everybody, the indirect risk, right? Dave, it's the consummate example. I think they don't have risk because I pay in my currency, but in fact, there's embedded risk almost always, maybe an exception or two here or there. And I've had numerous conversations with many companies about this very topic. This is a situation here. It's not unique to the Chinese yuan, but this situation is somewhat special. And so the idea is take more direct control of the risk, as Dave mentions. And so this exchange rate movement will appear somewhere in the supply chain or in the financial aspects of it. So the idea is here, for example, if in that case you could ask for, if not pricing RMB directly, if they won't provide that, only a dual invoice, how many RMB would you want, how many dollars would you want, and then work with that. But again, the idea is taking more direct control as opposed to being passive, which Dave's client was. So this is a very hot topic nowadays, to be certain.
Yeah.
So going back to, so moving on, so procurement, purchasing, and I would say also the coordinating with local foreign operations teams and such. And I worked on this, one project I worked on was to eliminate, again, unnecessary conversions. There was a situation in which the financial hub in Cork, Ireland funded the office in the Czech Republic, which converted the funds to Czech koruna, but then subsequently paid euros to a vendor. And so very simple to establish a euro account, don't convert them to Czech koruna, pay out, avoid the leakage. So that was a collaboration with the foreign operations and somewhat to a degree procurement. Accounting, somewhat obvious, calculates, makes the entries, calculates mark to market, prepares documentation of hedge accounting if the company elects hedge accounting. Treasury finance, that's very obvious, really the core manager of FX at a company, to manage the risk, the positions, simple payments as well, manage the current accounts and so on, administer accounts and investments. FP&A, of course, the budgeting process, very, very important. I'll say this, it's actually somewhat in the back up to the sales part as well. Price books, setting for budgets or price books. The office in Latin America said, well, we want to use for our dollar Mexican peso price book or our Mexican peso price book, we want to use the 12-month average or 13-month average of the exchange rate. Had we done that, we would have been immediately at a loss of, or lower than we should have been by 20%, I believe, if I recall correctly. So it wasn't just a simple, let's take an average of the exchange rate, because that's not reality. So again, coordination amongst sales and marketing, FP&A for budget rates that are used in sales contracts and price books, very, very important. Tax, very important in transfer pricing, as you may know. Often it's said that you wait to find out how many funds we have to transfer before we know what we'll hedge, what action we'll take. Repatriation strategies of dividends, also important, many ways to go about that, and close collaboration between tax and treasury and finance is very important. IT, and now maybe Rob can add some examples to this because he really goes into the deep plumbing of the systems, but they manage the ERP systems which contain all this data that we keep talking about. So Rob, do you have anything you want to offer? Any anecdotes or any comments?
Anecdotes, I don't know. Yeah, that is a common challenge for Treasury. If you don't have an assigned financial reporting, let's say an IT liaison there, it's not always up to Treasury to be able to run the reports that you would think that they would need. They often have an IT resource that they lean on to do that, and that communication is critical. We, in our situation, will coordinate with IT departments and sort of help bridge that gap with Treasury teams. But the better that Treasury can lean on their IT folks to get data out, the better off they're going to be. Visibility is where it's at. That's what people look for.
Yeah, thanks, Rob. And actually, something else just came to mind. Back up to accounting, very important. I've been in a situation in which accounting booked, or would more than one occasion book entry for current euros against pound sterling, euros against dollars, whatever it may be, but not in foreign treasury, which was responsible for hedging the risk, and so it was really shooting at a moving target, right? So being unaware and knowing after the fact, oh, that's what that was, and so lack of collaboration. Again, that's why we mentioned that in the very first slide as an iceberg. Simple communication, in addition to the systems and that we've talked about, can really resolve these problems and avoid the icebergs, as we've mentioned. So good. Well, we've talked about this already, the indirect risk, Chinese yuan. It's not only in that currency pair, but that's, again, a common theme nowadays. And but that's what we want to cover today. And Bruce, I'll open it up for questions or comments by you first, if you'd like.
Sure, let's see if we have, we've got some questions for the assembled audience here. Okay, remember, for those of you who are on the call, please type the question into the question box on the lower right-hand side of your screen. All right, here's a question. What software have you seen to assist with data aggregation and risk identification?
Rob or Dave, you want to handle that? I have an answer, but I think you guys would.
Yeah, I'm gonna have Rob take that one.
Yeah, I think data, that's a good question. There's a number of vendors out there that do a number of different things. So you talk about data aggregation. You have the ability to get data out of your ERP system. I think there are, I'm trying to think of specific named vendors, although that has kind of changed over the last number of years, where fewer and fewer companies are open to having a third party, let's say, drill into their ERP environment. This is much more turned into a push data up than it is to go in and pull data out. But there are subscription-based models. I think Kyreba's got a piece there.
Well, and then you've got the companies, like a Domo that,
Yeah.
or Power BI that are, business analytics tools that's what they're made to do, is go and pull data out of systems so that you can do a better job of analyzing what you've got out there from an exposure data standpoint.
Yeah, and HFM or Oracle's got like a Hyperion consolidation tool that you see a lot of companies go to. Let's say you're bringing in a number of different ERP systems. You're trying to pull those together for your financial statements. There are some aggregation tools there that are just for financial statements. So the challenge there is from the FX side is everything gets converted to the functional currency, and you sort of lose that transaction level identity of FX. But there are some consolidation tools out there just for Oracle, SAP. The bigger shops have, the bigger ERPs have consolidation tools.
And Bruce, can you ask the attendee, does that answer the question, or is there more that we can add to that?
Yeah, I think maybe this individual will just clarify, when you talk about data aggregation, is that really internal data, or is there a need to aggregate information from, let's say, outside?
Yeah, and I'll tell you this, Bruce, from our team standpoint, that's one of the things that we do quite a bit. Is we'll have clients that'll be on 6 or 7 different ERPs, and they've got different data that they can get out of different ERPs in different formats. And we do a lot of data aggregation on our side. And when we start collecting data from people that are on multiple systems. So we do quite a bit of data aggregation here, and we think we're pretty good at it as well. So, there's a lot of different answers to data aggregation, because it means a lot of different things to different people.
I will tell you from personal consulting experiences, one of the problems, and I think you mentioned this earlier, is as a company, if you're selling under contract,
yeah,
you could have risk embedded in that contract, and you will never see it, because the ERP system, quite frankly, doesn't care about your contracts. Treasury will not see it until maybe after the fact, and even then, it's still sort of shadows on a cave wall. So one of the issues that I've seen is really the need for a foreign exchange policy that assigns the responsibilities for reviewing situations where you could have embedded foreign exchange exposure, like a long-term contract.
Right.
Because procurement does their thing and they sign the contract, and then the contract goes in a desk drawer. Or certainly it is not set up in a way that you can see the terms and conditions in that contract. And so now all you're doing is you're settling a transaction and booking a gain or loss. And of course, by then it's too late. So,
Yeah.
And Bruce, to be certain, I think Dave's answered that, so be sure that we don't miss, or that we communicate clearly. Our offering does do that, what Dave mentioned. That's why I asked what the specific question is, because it depends on that. But our platform, we have software developers on staff, as I mentioned, that does that. Just depends on the specific need.
well, how, I mean, that will actually extract language out of a contract and then highlight an exposure?
No, not language out of a contract, but actual data when we're talking about the financial data these guys.
Yeah, no, I mean, the problem I've seen is that the language is buried in a contract, and quite frankly, no one sees it.
Okay.
So, you can't aggregate what you can't see, I guess. Well, here's another question, though. The question is who to contact for a conversation about exposure management services by GPS. Is that Jason? Is that you, or is that?
Yeah, start with me, and I'll coordinate as depending on the need.
Okay.
Coordinate with Dave and Rob as well. We all work as a team here, but yeah, I would be the primary contact.
Yeah, yeah. And here's a question about pulling information out of contracts. And yes, there are internal spreadsheets, but the spreadsheets are just a way of writing down the data. I have not seen, to answer this question about is there anything better than an internal spreadsheet to pull data from a general ledger? That's where, in a sense, that's where artificial intelligence could play a part. But even I would question, given the way contracts are written, whether any system could really interpret that contract to understand how it's written. And the unfortunate part is contracts are written by lawyers. And I will tell you, have you ever seen a 12-page run-on sentence? I mean, how do you interpret that? I don't know.
Very many commas.
So
right.
So there isn't anything that I know of except for a lot of people spending a lot of time. And then once you do that, then the question is, where do you put it? That's a fair question. And I think, as you guys have said, you have a place for that.
Yeah, and I'll say as well, from the personal experience, I've seen, our system does many great things, and there are other for that software packages that cost monthly subscription, Fire Apps, Atlas FX. But the company it was still a challenge. I don't mean to come across as negative, to sell the negative, but the reality was, even for the pay for software, we had limited access to help. It still missed some, I think, because the process wasn't there yet. And the company still used Excel spreadsheets. So it was a really combination, not ideal. I think hopefully they've graduated from that to purely using the system. But Excel spreadsheets have their place, let's be fair. But it's about, as the complexity grows, as the organization grows, to become, useful for other reasons, but not really the core data management. So I would propose that.
I think you bring up a good point. I've seen the same thing where I compare spreadsheets to sort of the grease that keeps the various systems running. And that really tells you something about the systems themselves, is that you have to continually grease and oil these things because the output of system A doesn't really fit into the input of system B. Do you blame the system? Do you blame the process? I think that in many cases, I've seen systems help you make your mistakes faster. And as a result, people continue to depend on spreadsheets because they just can't make those links work. And there's something, I wouldn't blame the vendor there. I think there's something else at work.
Yeah. I mean, yeah, exactly. Again, I didn't mean to sound too harsh, but in this case, it was a system of the GL, the accounting software that could not communicate. There was something slightly off between the number that the accounting system generated and the pay for service generated. There was always a difference. So yeah, anyway, good point, Bruce.
Yeah. I mean, one of the things, one of my favorite sayings here is that perfectly accounting for your foreign exchange losses is not a goal.
Yeah.
The goal is to avoid the loss, and there's very little that a system can do, artificial intelligence aside, that can really predict what those losses could be. Again, they're embedded in a contract. Obviously, you have, a pandemic, situations beyond your control. So accounting for those things is not really the issue. The issue is how do you look out? And again, to keep in the nautical vein here, the lookouts on the Titanic actually did see that iceberg.
Yeah.
They just could not react in time. And so I think that is something that companies really should focus on. And then, of course, to react in time, you need, I don't know, some sort of a tool.
Navigation tool.
Yep. So I think in the case of the lookouts, they could have benefited from some binoculars.
Yeah, precisely.
But all right, we're reaching the magic 1 hour mark here, and I think that people want to go back to their real jobs here. So again, sort of a last call for questions. I think there's a lot of good examples here. And again, Jason, when you're all done here, if you could send me a PDF version, I will make sure everyone gets that.
Glad to. Thank you.
And so last call for questions before we get on with the rest of our day. Okay, in that case, let me shut this down. The recording will be sent to you automatically so that you can peruse this at your own speed. So again, my thanks to Jason and Rob and David. And the only thing we can certainly look for in the future is that the rates will continue to change and that exposure will always be there. So get best to do something about it.
Indeed, change is the only constant, right?
That's true, yes. All right, with that, I'm going to close this down. Thank you all for attending. And again, any more ideas for maybe a second part to this, please send me an email.
Thanks, Bruce. Thanks, everybody.
All right, bye-bye.